I fed 35 years of gold and stock market data into a model, and what I discovered completely blew my mind. Imagine turning just 10 lakhs into 90 crores, while if you'd only invested in stocks, it would have grown to 6 crores, and only in gold to 4.5 crores. That sounds too good to be true, right? I thought so too. So today, I'm not just going to tell you about it, I'm going to show you exactly how this ridiculously, surprisingly simple strategy works. It's based on just one powerful metric, that is the gold to Nifty ratio. This ratio clearly signals when you should shift your investments from stocks to gold and then back to stocks. Stick around, because in the next few minutes, I'll break down this gold to Nifty ratio strategy step by step. Trust me, you don't want to miss it. No one that I know of on the internet has shared this publicly. So let's get started. Hello everyone, I'm Udayan Adhye and I've been licensed in Indian financial services since 2015. And so far, I've helped over 1,500 families take better financial decisions. And here on my YouTube channel, I talk about all things money and personal development. Now, before we jump into the specifics of the gold Nifty ratio strategy, let me quickly share with you 3 foundational insights that make it so powerful. First, take a look at this table here showing the annual returns of stocks and gold side by side. Do you notice anything interesting? You'll see right away that stocks and gold don't tend to move together. For example, in 2008, stocks crashed by 60%, but gold was up 29%. And then in 2011, Nifty dropped by 29%, but gold jumped by 29%. And you can notice this happen at different times as well. Now, the fancy investing term for how different assets move compared to each other is called correlation. And when I measured the correlation between gold and stocks from 2006 to 2023, it came out to be minus 0.12. What does this even mean? A correlation of +1 means that two assets move exactly together. A correlation of -1 means they move exactly opposite. And minus 0.12 is very close to 0, right? Meaning stocks and gold have no connection. What affects one does not affect the other. So adding both to your portfolio could be a wonderful idea. Secondly, in the world of investing and financial markets, everything is cyclical. No one single asset class does well forever. And just like that, there are periods when stocks do well and there are periods when gold does well. Think of it as tides in the ocean. There is a high tide and then there is a low tide. Just like that, usually when one asset class has done well for a few years, it tends to slow down in the subsequent years, and that's when the other asset class, which had been lagging, starts picking up steam. The technical term for this is called mean reversion, but you don't even need to remember that. Just know that something like this exists. And thirdly, all of us have a limited amount of money to invest, right? Whatever that is, whether it's 1 lakh, 1 crore, 10 crores, it doesn't matter. The point is, how we allocate this money, how we allocate this capital becomes very critical. Because if your money sits in an asset that hasn't been performing well for too long, you're going to lose out on returns, and that means your money won't compound at a good rate. If you want to apply what I share here on YouTube to your own life and investing, check out my program, The Complete Guide to Mutual Fund Investing. It has all my years of experience of being licensed in Indian financial services since 2015. In it, I've covered topics like how you can select mutual funds to invest in, how to build your mutual fund portfolio, a much deeper dive than this particular video, what is an SWP and how to plan for your various goals, among other topics as well. The guide also has Excel tools like this one, where you just enter the goal that you have, the money that you require for it, and it automatically tells you, factoring in inflation, how much you need to invest per month from now onwards and which mutual funds to go for to save for that goal. Once you sign up for the guide, you'll also be part of our monthly live Q&A sessions where I answer all your doubts. To check out the program, go to the first link in the description and the pinned comment. Let me introduce you to the gold Nifty ratio, what it is and how to form a strategy around it. As we move forward, I want you to listen to this part very carefully. It may seem a little complicated when you first hear it, so you can go through it once again, but just stay with me. The gold Nifty ratio sounds like a very difficult concept, but it's actually very simple. It's just the price of gold divided by the level of the Nifty or the price of the Nifty. That is it. One simple number telling you how gold is performing relative to stocks. Now, when this ratio is rising, gold is getting stronger compared to stocks. When this ratio is falling, stocks are getting stronger compared to gold. Here's the Gold-Nifty ratio, just to give you an idea, from the start of 1990 till literally Friday, which was 25th April 2025. I'll tell you how to plot this. There's a very easy way. We'll go through it step by step. But there's one very important point to understand. Just because the ratio is rising does not mean that stocks are falling. Stocks could still be going up. But if gold is rising faster, this curve will go upwards too. Similarly, when the ratio is falling, it doesn't mean that gold is crashing. It just means that stocks are delivering better returns compared to gold. In very simple terms, this ratio, this one single line, helps you see who's winning the race, gold or stocks at any point in time. Now, before we start building this chart and forming a strategy around it, it's important to understand one more important thing. We are not obsessing over the exact value of the chart at every second or every day. What we are really interested in is two things. Firstly, the direction of the line, right? So whether the line is trending upwards or whether it's moving downwards over a period of time. And secondly, which is very, very important, is that we want to know at what zones does the line get contained within. Because knowing those zones tells us at what point to move away from stocks or to move away from gold or into stocks and into gold. So just to help you understand this is the Gold-Nifty ratio. I'm just going to set up those zones, right? So if you notice, more or less it operates within these two boundaries. At times it goes up, at times it goes down, but for a major part, it's within these zones. What to do with this? We'll get to it exactly. You can see something on the screen, but we'll get to it. First, let's understand how to build this chart, because that becomes important. That will help you understand how it works, what it is, and then the strategy becomes easier to execute. So the website that you saw was TradingView. So the very first thing that you want to do is you want to go to tradingview.com. So I just Googled it. I go to the first link available. Step number 2 is we want to go to search, and we basically want to paste this particular series of letters and numbers. What this means is that first we're looking at price of gold. That is it. But price of gold on TradingView is in dollars. So we want to convert it to rupees, right? So that's why we multiply it. This is the multiplication sign by USD INR. But even then, that's not entirely accurate, because when you're buying gold in India, you're buying it at a certain higher price because of import duty. I've considered an import duty of 10% here. That's why it's multiplied by 1.1. Now, it's not exactly accurate because import duty historically has changed, but 10% gives us a good number somewhere in the middle. Even then, there's one factor missing, which you'll notice divided by 31.1. That is because the value of gold when it's traded in dollars is in troy ounce. We want to convert it into grams, so it becomes accurate to the Indian concept. So we divide it by 31.1. Now we have figured out gold. Now we just want to divide this entire gold price by Nifty. So we get the gold to Nifty ratio. So I say / and then Nifty once again. So once you press enter, you basically get the gold to Nifty ratio chart. Now, if you notice one thing right away, you will see that it does not move in a straight line, right? It's moving up and down, and it's doing that all across this entire 35-year period, right? It's choppy, it's like a small valley, then it's like a small hilltop, but it keeps changing its values over a period of time. But if you were to just visually, right, without getting into mathematics, just sketch out the rough edges of the boundaries within which the line tends to operate, at what points it tends to reverse direction, whether it goes up or whether it goes down, you would start forming some natural boundaries, both upper boundary and lower boundary. You got a glimpse of it earlier, but these rough edges, these peripheries become our zones. These are the zones that we are interested in. These are zones where historically, whenever the line has ventured into those areas, it has signaled a change in direction, a change in which asset class is doing well, whether stocks are doing well, whether gold is doing well. So you're not trying to guess the bottoms and tops. That is not what we are doing. We're just observing the zones at which the line starts to change direction for a long period of time. So if you were to just visually create these zones, I would personally pick these. So we don't want to make sure that every single sort of hilltop or a valley is captured, but more or less a lot of them are, right, where there is significant change in direction. So you notice the first sort of change in direction occurs in August 1990, and then it goes up a little, it ventures into that zone, but again falls down. And again from here on, there is a significant change in direction. And you'll notice at different times, it doesn't entirely breach the different zone, but again, once again goes up, once again comes down. Now what I'm going to do is, I'm going to show you the Gold-Nifty ratio, but also against the price of Nifty or the level of Nifty and the price of gold. This will give you a very powerful indication as to how insightful this particular strategy is, right? So if you're ready, here we go. You'll notice Nifty 50 here, you'll notice gold here. We once again used all the multiplications and divisions for gold to get the price in rupees. Now at this point, right, I just want you to focus on two areas. Firstly, when it goes in this top area, when the line touches this top area, you want to reduce gold and you want to add stocks. Similarly, when the line touches the bottom area, you want to reduce stocks and you want to add gold. When was the last time this particular line breached the lower boundary, right? Lower boundary where you would have reduced stocks and added gold. Now, it has done this so at various points, right? But when was the last time it did so before hitting the top zone? It was somewhere around here, right? November 2017, right? So I'll just create a small line there, vertical. And now what I will do is, I will just calculate the return of gold and the return of stocks from this point on, right? So gold has basically gone up, let's say about 240%, right? From the time the Gold-Nifty ratio told us to switch to gold. At the same time, if I were to do the same thing for even Nifty, let's just see here, sometime in November 2017 to right now. Can you see the difference, right? 142% is what Nifty has generated, whereas gold has generated 240%. This is insanely powerful because all it did was breach that zone. And this zone we have come up with historical context, right? Just because of that one change, we can now see that gold has performed much better since 2017 end, almost start of 2018 till now. And this is despite the spectacular rally of stocks since the COVID crash. But just think about it, right? During this entire period, when the market crashed by 40% here, gold actually, right, during this period, if you just see where my mouse is hovering, you will see that from this period, when the market wasn't doing well, gold actually went up. So it warrants for adding gold. It showed that 2 years before, and historically it has done that spectacularly. And that is where the magic of this strategy lies. It has done so 8 times. So the way this works is, we want to first look at, I'm just going to zoom into the Gold-Nifty strategy once again. I'm going to remove this one line, right? So there you go. Now that you understand what the Gold-Nifty ratio is, which essentially means that if this line is curving up, that means gold is doing better than stocks. When it's going down, it means that stocks are doing better than gold. So then in that case, the way to form a strategy around it is that every time it hits the upper zone or lower zone, you switch asset classes. So let's go through this one by one, right? So the first breach that happened, if you look at it here, is in August 1990. So at this time, you essentially start reducing gold and start adding stocks. It goes up a little, but again comes down, where once again, in about March 1992, you want to reduce the number of stocks you have, start adding gold, which will continue until once again this line is breached here in April 1993, which is when you will start reducing gold, start adding stocks. Again, this feeds into the cyclical nature of the stock market, mean reversion, and this switching between assets basis that. Now, if you notice, this line goes down, 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 but it never really breaches this zone or touches this zone. So the idea is, in this strategy, you do not do anything until there is a breach. So that breach happened here in August 1999. It again went to the higher end, but that's just a part of just how investing works. Unless there's a breach on either side, you do not change. So you'll change here. There was a breach downward here, but obviously you've already entered stocks here, entered gold here, right? Sorry, you've reduced stocks, you've entered gold. So you'll keep holding up until this point, when once again there's a breach on the higher end. You'll exit stocks sometime around September 2005. Now at this point, there's something very interesting that happens. During this period, the Indian stock market from September 2005 till the start of 2008 was just going up, before the 2008 financial crisis. So at that time, for that window, you would have been in a asset class for that 2-year period when the other asset class, your unfavored asset class, would have been going up. But that would have performed really well in hindsight if you had stuck through that entire period. And you keep repeating that, right? I have plotted every breach in a Google sheet, which by the way, you can get access to for free. Here's the Google sheet. So you notice start is the first, the 8 zones that we have had. It gives you the start and end date and the favored asset class for that particular window, right? So at that point, Nifty was at 400. By the time you exited, Nifty was at 1,261. Then came gold, which was the favored asset class. If you notice, gold was 353 and it went up to 399. Notice something interesting. During this period, Nifty halved, whereas gold grew. Wonderful, right? Then you would have switched out into stocks at this point in 1993, where stocks would have doubled in value. Gold would have just gone down a little. But you see how powerful this strategy becomes. And to make this even more apparent and to just give you the exact rational, exact calculations, here's the thing, right? The multiple by which that asset class went up by during this window. The stocks increased by a multiple of 3.15, gold by 1.13. And if you notice, every single time one particular asset class did not go up by as much, the other went up by a large amount. So then in that case, you would notice that you are very, very strategically timing your move from one asset class to the other. Now if you notice, if you were to execute this with real money, the Gold-Nifty ratio switch, and this is with the idea of having 10 lakhs invested at the start. Obviously, 10 lakhs in 1990 was a huge amount. Most people would not have access to it, but don't focus on the 10 lakhs. Focus on how many times it went up by. I'm just using 10 lakhs as a metric. It could be 100 rupees, 1000 rupees, doesn't matter. It's the multiple by which it went up by. So if you notice, in the Gold-Nifty ratio switch strategy, you have 90 crores as the portfolio value today in April 2025. That's an annual return of 21.7% if you deduct taxes from it, which there would be, right? Because every time you're switching, that it would be a taxable event. Even then you have 52 crores. This data, this sheet is accessible to you. The Nifty ratio chart, the Gold-Nifty ratio chart is accessible to you. You can verify it independently. The post-tax calculation is right here. You can check it out. You can verify it. But let's go back to this. A simple Nifty buy and hold would have given you 6 crores. And Nifty and a gold buy and hold would have given you about 4.1 crores. Look at the returns, 12.5, 11.3 and 21.7. Isn't that mind-boggling? Isn't that crazy? Now, the thing is, this strategy involves switching out 100% of your money, right? From gold to stocks, stocks to gold and vice versa. You just keep doing that. In reality, that would not happen. You would not just switch out 100% of your money. It's too big a risk, correct? So in that case, what if you were to, instead of switching 100% to just the asset class that is doing well, you switch 60%, right? So when gold is doing well, 60% of your money is in gold, 40% is in stocks. And when stocks are doing well, 60% of your money is in stocks and 40% in gold. If you were to do that, you would still end up with 14.5 crores or 9.4 crores post taxes. It's a return difference of about 2% post taxes, which is fantastic, right? And just that small kicker, with just having 10% more in one asset class, gives you much superior returns than simply holding Nifty or gold. You can experiment with the allocation. So instead of 0.6, 0.7, what if it's 70% in the favored asset class? What happens then, right? 12.1% here, 15.5% in the Nifty, Gold-Nifty switch strategy. One factor to consider here, which has not been considered because this calculation was very complex, it would have made it even more complex, is the expense ratio of the gold ETF or the gold fund that you're buying or even the Nifty index fund that you're buying. So you can basically deduct, I would say, 0.5% or 0.6, 0.7% from the returns here. So you'll get the post-expense fee as well. But even that difference, right, would still not be enough to completely get rid of the gap between the actual returns of these strategies. Something very powerful, something very straightforward. Again, if you were to get into the technicalities, for example, in 1992, if you had bought gold, if you had sold it in April 1993, as per the current taxation laws, which I've considered, by the way, I haven't considered historical taxation laws, because again, they just keep changing so much, it's very difficult to execute anything. I've considered a 12.5% long-term capital gains. In this case, when I'm calculating the post-tax returns, I've just considered, despite it being less than 2 years the holding period, I've still considered a 12.5% long-term capital gains. Because that was the only instance where you did not hold either of the asset classes for more than 2 years. With stocks, it's 1 year, so it doesn't matter anyway. But the idea of this video, right, was just to plant this seed in your mind. That such a simple strategy, which is accessible to you, which is free to you, gives you something so powerful. Because we keep talking about all these complex trading algorithms, hedge funds, and all those things. But if you simply invested in two of the most popular asset classes, gold and the top 50 stocks of the Indian stock market, it would have given you something very powerful. One point, which again, as an exception that you need to know of, is that in this entire window, right, what you see of Nifty here, that is not considering dividends. It's before dividends. So the total return would be about a percentage to 1.5% more. So something to consider there. But this gives you an idea, right? Once again, a simple strategy, so powerful that it absolutely boggles your mind that something like this is even possible. Of course, this is backtested data. I got to know of this. I'd been using ratio charts for multiple other things for a while, but the idea to compare gold to Nifty and create a trading strategy or an investing strategy out of it came to me when I watched Alok Jain, who is the founder of and chief investment officer of Weekend Investing. He follows the momentum style of investing. When I'd watched his video a long time back, I think it was during this period when I'd watched it, somewhere in 2020 or so. That's when I had loaded up on gold in my portfolio. So big shout out to him. He introduced me to this strategy. The number crunching, right? All this number crunching of 10 lakhs to 52 crores if you're switching 100%. All of that I don't think has been shared yet. I think it's, there you go. I just switched it back to 100%. Now, one more important caveat. This strategy requires courage, right? Because essentially you are exiting an asset class that has performed well in the past few years, and you're investing in an asset class that has not performed well in the past few years. So it requires immense investing discipline, incredible mental energy, mental focus and discipline. But if you were to execute it, you saw that the rewards were yours to enjoy. That's it for today. Share it with people if you enjoyed it, if you learned something new. And again, if you like this video, if you want to delve more into portfolio building, here's one more video I made where I shared with you 3 safe investing ideas. If you are a conservative investor, if you're a new investor, if you're just someone who wants less volatility in your portfolio. Thanks for watching, and I'll see you in the next one.